Hi, this is Randy Finney with the right side of the chart, and today is Tuesday, March 15th, 2016. I'm starting this video a little after 3 o'clock Eastern Time, so we have a little less than an hour to go in the trading day. And I'm going to try to keep this one brief. I know I often say that and they go on, but I want to get this out before the market closes. Nothing major, but there are a few developments worth noting, and I wanted to just run through the index charts and then really pay a little focus on the Qs. That's the excuse me, the index that led this bull market up, and may very well lead us down if there indeed is another leg down coming here soon. So this is the 60-minute charts. We'll just start there. Look at IWM. As I mentioned recently, personally I have no desire to be short the SPY, the S&P 500. There's too many commodities and basic materials and other sectors that appear to be bottoming and look good, not to mention the dividend stocks. So I'm going for those such as stocks in the small caps, the higher beta indices, the small caps in the Qs. You tend to have fewer dividend-paying stocks, and Qs. The NDX is very tech-heavy. So here's the Nasdaq 100. This is pointed out in the site, so I won't spend too much time on it. Here's the trend indicators. We had a little whipsaw signal here recently, but now we're back to bearish again with that little red cross here just recently on the 1333 pair. And more importantly, since the action so far has confirmed this bearish rising wedge, we had a breakdown, an initial thrust down. We had a move up that failed to even come back to the highs. It shows that there's really a lot of selling pressure. You can see that the IWM, as I do this video, is down nearly 2% today. So quite a different story. You know, the Qs are being held up, and I'm going to get to that and look at that. And again, put a lot of my focus there. I just wanted to mention that the current short on the site, I believe we have an official short. I know I'm short TNA, and I think that's an official trade idea. I'm sorry, there's been so many lately, and that still looks fine right now. I don't see any reason to be concerned at this point on it. The Qs, here's that bearish rising wedge pattern breakdown. We moved higher, but we didn't even back test, and we've just made a marginal new high. Most importantly, as I talked about in the recent video, is this down here. All this new high did, this marginal new high, it's not really been confirmed on any high volume. In fact, low volume. Market's just pushing up, and it looks like prices are rolling over. Most importantly, that divergence that I had in place back here to confirm the bearish rising wedge pattern before it broke down has only been extended. In other words, we've made another lower high on the MACD as well as the RSI and the 13.3 trend histogram. So you can see we have this long divergence. It's not really drawn out here. It's just that from that other peak. I have to draw the line up here, move it down so it doesn't grab those other lines. And you can see, so there's the price is making that other high. So again, my expectation is for more downside. At the very least, there's a mountain of resistance overhead. So I think this is one of the more favorable times this year, other than the breakdown that we had on the first trading day of the year on January 4th, when the Qs gapped down below this trading range, and we had that back test. That was the most objective short entry of the year by far. And now I think this is probably, and I'm talking swing shorts. This is, I talked about this when we hit this level, that we'd probably chop around for a few weeks. I went to a net bullish stance, but I also made mention at the time, back then a couple months ago, that there was a good chance we'd see the markets chop around in a wide sideways trading range, with a slightly upward bias, and that's what's happened. So swing traders, even longer term traders wanting to position for what could be another leg down. This is about it's well, without a doubt, since the early breakdown in January, or the breakdown in early January, this is the probably the most objective time to start scaling in, however you want to do it, a single position. Still not load the boat time because there's some mixed signals, but don't go too crazy on the short side using too much leverage or anything like that. But that's it. So I talked about the overhead resistance levels, divergences confirm, and we just need to see prices. At this point, they really should roll over soon. After a breakdown of a wedge, it's okay to sometimes see one additional thrust to new highs. You don't want to see prices really slog around sideways here or move much higher from this point, in my opinion. It will undo a lot of the bearishness on this chart. And when rising wedges, or falling wedges for that fact, break out, typically the move begins shortly thereafter. And as I said, sometimes there's one more marginal new thrust. And so that's why I want to see prices start to head down. Keep in mind, this Friday is options expiration for the standard contracts, and I've talked in the past How they, at many points, they'll tend to hold the market up into options expiration, especially if there's a lot of puts out there. And we know undoubtedly in the last few months there's been a lot of put buying. Bearishness was at extreme levels down here, and even as we came up here, a lot of people thought that that would be the area to short. And so who knows, maybe they hold this market up into Friday to roast a lot of the put buyers, and then the fireworks start next week. This is a SPY, the S&P 500 tracking ETF. That one did break down, made a virtual backtest, a near backtest, and has so far seemed to roll over. But again, the charts right now, you have the resistance levels overhead, just a mountain of resistance, and more importantly, 60-minute bearish chart patterns, bearish rising wedge patterns on all of the major U.S. indices, and that's what I like to see, especially during a intermediate or long-term downtrend, which I've recently made the case that we're in. It doesn't get any better than that. You see these 60-minute bearish patterns. I can't promise they'll play out, but I can tell you it just doesn't get much better than that to put on shorts and have your stops there. All right, so enough of that. You guys will make your own decision whether you want to short, not short, be long. Let's dig a little more into the charts, and now let's go back to the Qs and just focus on the Qs, and then we'll wrap this up. What I'm going to do is take a look at the top components. I've been watching that closely. These are the stocks, the QQQ, the NDX 100, NASDAQ 100 led the market up throughout this entire bull market, and just in about every advance that we had, it was the strongest index. And of course, as we all know, the Qs are made up, the top 10 holdings, at least last time I looked a couple months ago, made up over 50% of the entire NASDAQ 100. And even the top 5 at one point were, 30 or something percent, or a third of it. It's gone down a little bit because we've had Apple come well off its highs. Apple's been in a bear market for a while. So let's pick on Apple first because it is still the largest component in the Qs. I think it's about 11% last time I looked. And look at this beautiful bearish rising wedge. Very clean. You see from this point to this point, you have the divergent high. You see the MACD curling down here. It hasn't crossed yet. When the blue line crosses the white line, in other words, the MACD line crosses that signal line, you'll have what I like to call confirmed divergence. I like to see that crossover. But either way, the potential divergence is there, and you can already see the MACD curling down and turning back over. RSI is making a lower low, everything. So you have the divergence, which helps to confirm that rising wedge. And if you look at where we stopped today, if you recall, I've called 2 bottoms in Apple in the last in this year, and both those bottoms were the same bottom. Apple has had just awesome support. I pointed that out. 93 is just an incredible support level. If and when that goes, you don't want to be long Apple, and you probably will before all said and done. But we were able to go long here. We did an official long here, and I can't remember if this one was official again back here, but we had 2 longs off that level. Now, what I wanted to point out is the first long, as I often say, I catch bottoms and tops. We went long. You can reference that on the site. I'll show you how to in a second if there's time in the video. But that's where we went long back in January, and that's when nobody wanted to buy. There was blood in the streets. And at the time, I listed 2 price targets, mentioned that would be my preferred target. In fact, I made that the official target, and we hit it. And I think it was a quick 7% gain right off the bottom within a day or two, a couple days. I also added this T2 back at that point in time at 104.95, and the actual resistance level, if you look at the pop-up box, was 105.64. So I always set my targets, and it depends on the stock and a lot of other factors how much below resistance. But you can see what happened today is the stock came in and hit a high, made a high of just barely above that level. Let's try to get the cursor on it. The high today was 105. Gotta hold it right there, 105.18 versus my target of 105.94. So what is that, 23 cents on a $105 stock? Close enough for government work. So far it's stopped at that level. It's pulled back down. It's trading at 104.91 right now, 4 cents below. And that, my friends, is a resistance. That's what I'm trying to harp on here. That was a target that I've had all along. And I even stated that I'll leave that target there for longer-term traders or investors that want to ride out any pullbacks along the way. Well, these were the pullbacks. 1, 2, we slopped around, and you could have stayed long Apple that whole time, and you'd have a move from 90 roughly 93 up to 105, so not bad, even though it took a few months to get it. Like I say, I like to usually take the quick buck, get out when I think a pullback is likely. But again, the point I tried to or want to make here is the bearish chart patterns, bearish rising wedge, divergences confirming as a stock pushes up to a key resistance level, something I've been watching for months now, really all year. And let's take a look at the longer term charts. Art in the trading room asked today, and any thoughts on Apple? And I went ahead and pulled up the daily chart. Hadn't done that in a couple days. And look at this. We gapped up. This is a level I've had here, and in fact, that was a short target, swing short target from another short that must have been way up here near the highs, because I had a. This was a second target. I might have removed the first target, or you don't see it on here if it was up higher. Yeah, can't see that first target. So that was a former support level right here. The actual line is at 104.42. You can see a reaction high there, a reaction low there. We're trading normalized on that crazy day back in was it August of last fall when we had the meltdown, and then there were some reactions there. We broke below it, and now we came back. So that is on a scale 1 to 5. I've got to put that up there. At least a 3.5, if not a 4 for resistance. It's a pretty solid level, and it doesn't matter if we trade, through it intraday. I already mentioned that the sharper resistance, when we zoom down into the 60-minute charts, you can see it defined here by that line at 105.64. You can see the reactions back here. So that's really the 105.64 level, give or take. These things can move up or through or fall a little shy of those resistance levels, especially intraday. That doesn't matter so much. And if Apple can tomorrow gap up and the rest of the week, gap up and hold above the 105 level, and especially on a closing basis, yes, that does chip away at the bearish case. But right now, we have a stock that is approaching overbought levels, where the RSI is at 67 after moving straight up from deeply oversold levels. So that's an extended stock, even though it based here for a little while. Give it some credit. That helps justify that launch up there. But with that being said, the trend, you look at the MACD, is just barely crossing above the zero line. And so, as I mentioned in the recent video, this is a critical week for the markets. They are at a critical juncture. As every tick they start pushing up from here starts to chip away at the bearish case. But right now, the bearish case can still be made. So if they reverse and start moving down lower, we could start a nice little waterfall sell-off here in the near future. Very near future, that is. Apple weekly chart. This chart's been discussed a lot. This makes the case for the bigger picture that the Apple is in a secular, or at least a cyclical, bear market. By all these metrics, you can visit this weekly chart or a different variation in the live charts page. This 40-week EMA has done a great job. Everything else, again, that's been talked on. The PPO is still sell signal territory, bearish territory below the zero line. I actually, on Apple, I have a line there at negative 2.12. That's the line that really defines the bull and bear markets. On Apple, sometimes I'll use the zero line, but that's why I have that red line there. So there's a case that the top component of the Qs, the leading index, is at resistance with a nice bearish rising wedge pattern to confirm on the 60-minute chart, and then I'll run through the rest of these quickly. Here's Google. Google, you can see this nice resistance level here at 754-ish. Call it, defined by this support shelf back here. There's reaction highs underneath it, tagging it here. There's resistance, and if it pushes through there, there's some more resistance overhead. That's okay resistance, but I'm watching really this level. And if Google turns down, just like a lot of stocks, see the MACD is still in bearish territory, trying to get above that zero line. But as long as it remains below, as it was back here, that is bearish. It's a bearish trend. So again, what these stocks do in the next week or so here, even in the next few days, may very well determine and can certainly change the near-term technical picture, but it may determine the longer-term outlook or the intermediate-term outlook for the market here. This is Microsoft. That's the second largest component right now in the Qs, and you can see this is a pretty decent, not the best resistance level. Something worth mentioning, and if it punches through there, there's still resistance at 55.36. So these stocks have quite a bit of work to do. Probably should look at the longer-term chart on Microsoft real quick. So Microsoft looks good. That one's held up, but look at the divergences. Weekly chart, these divergences indicate a very likely trend change. The recent highs were a divergent high. This is their long-term trend line. So, for the overall bigger picture, we're a little ways, quite a ways from there. When that goes, you'll know that a bear market is well underway. When that trend line goes. Google, you can see a similar thing. It looks so far so good from the longer term perspective. And kind of the theme here too is that yes, the Qs have finally started to roll over. They've broken down as an index on the longer term charts, but some of these leaders, these mega cap companies, these are the largest companies in the world, and these are the money where all the money's been flowing into throughout the bull market. These are the leaders. When the leaders break, the bull market is dead. So that's what I'm looking at here, trying to make the case for. And, some of them haven't done so yet. There's Facebook. Sorry, that's a messy chart. Ignore all this stuff you see up here. What I would point out is this potential selling or buying climax, which can mark a top, and so far that has marked the top. You can see these divergences down here on the daily chart. They show all the way on the daily chart, and they're going to show up even better. Not so well there. Let's see, maybe on the 2-hour chart. I'm trying to get this video out so I didn't mark all these charts up, but yeah, you'd have to draw it like I had. I had that line on the daily chart. This was the uptrend line right here, and what you had, it made from this point, if you draw here a wedge, I guess I should draw that out instead of trying to explain it. Yeah, that shows you that high marks that high, so I can't use that divergence there. I'm sorry. Let's just use this wedge, breakdown, and near back test to that level. And so and there's also resistance as well if we look right here. We have these previous reaction highs, these reaction highs, and we're right about there. Actually, I should put it right on top of the previous reaction highs, as you can see here. There you go. Look how perfectly that lines up with that reaction high. The most recent reaction high right here from a few weeks ago, early January, a couple months back, and that's where we're at right now. So there's Facebook at resistance, and that's one of the leaders in the Qs. Amazon, nice resistance here. Look at that big gap back here. You had this reaction high, you had a gap right here, and those two lines defined by this gap still represent resistance now that they're being challenged from below. This was the primary uptrend line. So Amazon's clearly in a downtrend. It had this rising wedge type pattern. It broke down, back tested, moved down, had another thrust up. And if this downtrend that it's in now, which started at this point, continues, this is as good a place as any for that stock to turn down. And if it doesn't, we watch it. If it comes up through here, because we do have this recent reaction high, it's got to take out the top of that gap. That would be the next resistance. You'd expect that gap to be filled more than likely if Amazon can get up in there. And if it gets much above the top of that gap, especially on a closing basis, then again, that chips away at the bearish case. There's Intel, nice resistance level here. This chart's kind of messy. We had Intel as a short back last year. There was this head and shoulders pattern on the weekly chart. Played out really nice. Left shoulder, head, right shoulder, if you can see it here. Take away that line, you see the head and shoulders. And, broke down, played out well, hit support, and moved back up. It had sort of a stick save. This was that meltdown back in August, and it got back above that trend line. This is a long-term bull market trend line going back to 2009. We had another intra-week break of it. Prices rallied back up, but they still have a lot of resistance. This looks like a stock that is topping out. It hasn't broken down yet. It's flirted with a couple breakdowns. And, it's in a precarious technical position. And, until and unless it takes out those highs around $38, it's got a lot of work ahead of it to firm up the bullish case. Comcast, here's a weekly chart on Comcast. Divergent, look at the negative divergence here on the PPO, the RSI. It's a big rising wedge is all that is. Look at that 40-week moving average starting to roll over. And if and when Comcast breaks that primary bull market uptrend line, which goes all the way back to the 2009 lows, then you have this support zone right here. And that ends, we'll call it 49.30-ish, maybe even 49. So any move below that, it's just more than likely will confirm that Comcast is in a new downtrend. However, it's not yet. It's still above its long-term uptrend line. So like I'm saying, a lot of these individual components, the top components of the Qs, haven't broken down. Hard to make heads or tails of the daily chart, so I'm not going to spend a lot of time on there. That's just a choppy, grindy chart, not my type of chart to trade or analyze, so that's why I'm focusing on the weekly charts here. Cisco, that circle, disregard the bottom part. What I was doing, you don't have on TC2000 a parabola tool, so you need to use a circle to draw rounded tops, or I can add them after the fact with my screen capture software. So that's just a rounded top pattern. It looks like we punched up through it, but there's also this downtrend line that comes in right here. You can see not too far above. And, you know, I don't have much to say on that. Sort of a mixed technical picture. There's a downtrend line. You probably want to draw it off that high there. And let's get that down a little bit. There you go. So that would be a wall of resistance because there's horizontal resistance there as well. So if Cisco, if Cisco gets up there around 3160 or so, that would be bullish if it can break on through it. Gilead, I'll stop on the next one, which is Amgen. It's a daily chart, weekly chart, bigger picture, like all the biotechs. They've broken down their bull market uptrend lines. This was such a huge bull market. They went up so much, they have so much to fall over the long run. I think it looks like from here, it looks to be flagging right here, bear flagging. And this was a former, we had this as a short trade. This was one of many of the biotech short ideas from back in last fall. And it fell down sharply. Beautiful, you know, breakdown, back test with a divergent high of this channel, this yellow price channel here, and then it rolled over, hit that first target, had a little bounce like the market came back, tried to make an intra-week, you know, little fake out move, but so far it's really hugging that line. So it's in what I call a precarious technical position right now. But if you were going to short that for a long-term trade, you'd want to wait for that lower line to go, or at least maybe even that previous reaction low there around, call it 80, a little under 82 or so. And the last one, then we'll wrap up. Amgen, weekly chart here also. They had this uptrend from mid-2011, very well-defined uptrend line. It terminated with a bearish rising wedge pattern. You can see here on the top, steep negative divergences, broke down, hit that support zone I had here perfectly, right in the about smack in the middle of that, had the initial bounce back for a near back test and has now rolled over. So whether this was on a 5-minute, 60-minute or time frame or a daily time frame, this happens to be a weekly time frame, it's all the same. And you have these rising wedge breakdowns, and I really don't think that was it. Just from the scope of this pattern, the duration of the pattern, you know, going all the way back here to mid-2011, I think that's just the initial move down with more to come over time. And you can see prices trading below that 40-week moving average right now. So that's the near-term outlook. And again, here's our big one. I would probably put Apple as an official short idea. What am I doing? Typing the wrong symbol here. I would probably put that in as official short trade idea, but I think I already have the QQQ on. I know I'm personally short that. Shorting Apple, because it's the largest component of the NASDAQ 100, is very close. You have a lot of overlap if you're short the Qs. So whether a trade idea is official or not, there they are. You know, I may even take some Apple to have some of the, you know, the individual exposure to just Apple and not, you know, all the other sectors that make up the NASDAQ 100. So if Apple, you know, I think it's objective because you can short it here with a stop, let's say over 106, especially on a daily close. Maybe a 60-minute close over 106. The stock's, you know, just under 105 right now. And then you're shorting at the top of a wedge. And the next entry, objective entry, will be a break of this rising wedge. And then as each or all of these levels start to go. And as I mentioned, just as with the broad market, we've already spent a lot of time testing that critical support. If Apple even gets close to that support, I would highly expect it's just going to smash right on through it. It might stop and visit it for a day or two, maybe a couple hours, maybe a few minutes, or maybe smash and gap right on through it. That's just my take on where we are with the bigger picture. So if you start to see things roll down, Apple, the broad market and everything, especially beyond this, past this support level right here, around 97 and a quarter, say 97, yeah, we could even move that down. That would more than likely open the door. 96.75, we'll call it. Open the door for a move down to retest the lows, and any move down to retest the lows is likely to just, I think it'll be a knife through the heart on the bulls if we get back down that level, and re-embolden the bears who've just been, recently dejected, if you will, with the way the market's, how much it's moved up compared to where they probably thought it was going. So anyways, it's been Randy Finney with Right Side of the Chart. I hope you enjoyed. If you have any questions, feel free to drop me a line in the trading room or via private message.